Good morning, it's Jeff Christian, CPM Group. It's about 9:40 in New York on Tuesday, the 16th of March. I want to talk a little bit about gold and our trade recommendations. We had issued a gold trade recommendation, short-term trade recommendation on Friday, which was a stand aside. It said stand aside and wait. It was a continuation of a stand aside trade recommendation that we had made earlier in the week. We basically were saying that we thought that the price of gold could trade between 1675 and 1735. From a long-term investor perspective, that's a good price to buy. We've actually been telling some of our long-term investors to hold their powder for a little while because we think that the price could go a little bit lower in the second and possibly even into the third quarter of this year. So if you really want to be a bargain hunter, you might want to wait, but from a long-term perspective, we think this is a good price. The trade recommendations are for short terms, like what do we think is going to happen in the next week or two? And given the conditions in the gold market right now, and actually in the broader financial markets and the economy, watching the T-bond rate increase over the last week or so, we've been saying we would stand aside, wouldn't necessarily go long nor go short. Now today, our view has been that the price was in the range of say 1675 to 1735 the last week or so, and that we think it's going to continue in that range. Our expectation, the price this morning got up to 1736, but it came back off as we're talking. It's about 1730. Our expectation is that at some point the price goes back towards 1700. Or maybe even below 1700 and gets down to that 1675, 1700 range, at which time our expectation is that we'll issue a buy recommendation with the view that the price is going at least to 1735, and if it breaks forcefully above that, it could go much higher, 1760, and in the long run, even higher. So that's why we have said to our short-term clients to stand aside. We like a trade that has a risk-reward ratio of 1 to 3 or higher. We prefer to find markets where we think that you could reasonably stand a chance of earning 3 times as much as you might lose, at least especially on short-term trades. So that's part of the thinking behind what we do. The other part of the thinking is that we don't believe in gold. We're commodities market analysts. We're not true believers. Peter Monk, who created Barrick Gold, famously would say when people asked him why he had been so successful in creating one of the world's largest and most profitable gold mining companies, he said, "I don't believe in gold. I buy low and I sell high, and I hedge." We don't believe in gold. We think it's a financial asset. It rises and falls like financial assets. If a commodity or any financial asset only increases or only decreases, examples, oil in 2005 to 2008, or the stock market 2010 to the present, then you have to worry because markets, generally speaking, fluctuate. And if they don't fluctuate, well, you have to say, why isn't this market behaving like a market? When they do fluctuate, like gold and silver do, then you say, okay, I can understand that, I can analyze it, and I can make projections based on what I see as a market. That's our view on gold. As I said, we're looking to see the price a little bit lower before we tell short-term investors that it's a good price to buy. We're also finding growing interest in silver trade recommendations, partly because of the growing interest in silver, partly because a number of people drank the Kool-Aid, bought silver at $30, and now they are kind of worried that they haven't necessarily listened to people who were well informed about silver in making their trading decisions. Our expectation is that the silver price will rise. We expect it to rise between now and late April because of the May COMEX roll, and then we expect the price to come back off. So we're working with some of our clients who jumped the gun and bought a little bit too high, to put in some options on either side of that to try to earn back some profits and reduce their net effective cost of acquisition. But more on that in the days and weeks ahead. That's all I have for today. I wanted to keep it focused on gold and to a lesser extent silver, and on our short-term views. We'll talk to you soon, and we'll talk about some other things that perhaps are a little bit more granular and interesting. I should mention also that next Tuesday, CPM Group will be launching its gold yearbook for 2021. That's the definitive work on gold. It'll be about 200 plus pages. If it's like the other reports that we've done for the last 4 decades. There will be a webinar, open webinar. We probably will expand it from, typically we try to run it for an hour, but given the silver webinar that we had on March 4th, we may try to run this one longer and have more questions and answers, because there are a lot of questions that people are bringing to us in terms of gold and silver at this point, and platinum and commodities in general and the state of the economy. So that is next Tuesday, the 23rd of March. You can go to our website, cpmgroup.com, and you can find a place to register to plug into the webinar. You have to be registered, but it's free and open to the public once you're registered. And we hope to see you then, and we hope to talk to you soon.